Rivian released earnings after the market closed on Tuesday, had a really interesting conference call. Obviously, management sees a very bright future, but production is going to be really low in 2024. Don't expect that to improve a lot in 2025. And yes, management sees positive gross profit by the end of this year and then a positive gross profit in 2025 as well. But the balance sheet is still really stretched. The company doesn't have a large net cash positive position, and their operating expenses are still almost $1 billion per quarter, basically $4 billion run rate. The other really interesting thing is just a broad context is that Rivian sees a future where they can grow their production to be a mass producer of electric vehicles and still generate a 25% gross margin. That flies in the face of everything that we have seen in the auto industry. GM says that EV demand is weak. Ford says that EV demand is weak. Tesla's numbers show us that EV demand is weak. Their deliveries are down. Their revenue is down. Competition continues to come into this market. I just don't see how Rivian is going to be a 25% gross margin company, 10% free cash flow. That's still what management is projecting. I think those numbers are crazy, but I'm going to go through their earnings report and show you why I think it's worth questioning their numbers right now. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get to some of the numbers. I'm going to start right here with the income statement. And this gives their production numbers as well. So you can see that production was down in the second quarter. Now, management said that that's going to be ramping up a little bit. Second half of the year, they're still expecting 57,000 vehicles to be produced and delivered this year. But they are going to be below their third quarter number, 16,304 that were produced last year in the third quarter. They're expected to be more like their first quarter number. That was what they said in the prepared remarks. Revenue, $1.158 billion. Again, not much growth from a year ago, but that's because they're not producing more vehicles. Now, the interesting thing, when you listen to a lot of their comments and you look at some of the numbers, one of the things you need to put into context is they produced almost 4,000 fewer vehicles than they delivered. So deliveries maintained at a pretty steady level, but they were producing fewer vehicles. That means that you're going to be generating cash by turning the inventory on the balance sheet into actual sales. So when they talk about improved cash flow, free cash flow for the quarter, this is a big reason why, because they were selling inventory that was on the balance sheet. Remember, they did have some plant shutdowns, so those are supposed to be helping make things more efficient in the back half of the year. But we're definitely not seeing that with a negative gross margin of 39%. This is the number that management is expecting to be break even by the end of 2024. So we'll see if they're able to get that. They got a big ramp to do, and then also a lot of cost cuts to put into place. What I want to focus on right here is the operating expense line. Because when you look at Rivian and you look at the amount of vehicles that they need to sell and the margin that they need to generate on each of those sales, this is what they have to overcome. $924 million in total operating expenses in the quarter. That is up 6% from a year ago. So they're not cutting their operating expenses right now. Remember, they've mentioned a bunch of layoffs. Doesn't seem that that's making its way to the operating expense line, at least on a year-over-year basis. They are coming down slightly on a quarter-over-quarter basis. But just ballpark, this is about $1 billion in operating expenses. That's $4 billion on an annualized basis. If they were to sell 200,000 vehicles, let's say that, so that would basically just be the Normal, Illinois facility, they would need to make a $20,000 profit on each vehicle to generate a positive operating profit. If they get to 400,000 units of production, that would be adding in at least part of the expansion that's planned in Georgia. That would be for particularly the R2 and R3. That would mean they would need to make a $10,000 profit. Selling a vehicle at $40,000 means that you would need to have a 25% gross margin. Is that in any way reasonable? History tells us no. This is a look at auto gross margins. There's a number of companies here, but you can see that the general trend is that gross margins typically end up between 10 and 20%. On the high end, you have a really good operator like Toyota, closer to 20% typically. A more traditional automaker like General Motors is going to be more like 12, 13%. Tesla is kind of in the middle there. Right now, margins have fallen. They peaked at around 30%. That was during the pandemic. Were making plenty of vehicles. They actually raised their prices. As those prices have come down, competition has gotten stronger. We have seen those margins come down to more like 16, 17%. So none of these companies are generating over a 25% gross margin, which Rivian is still projecting, except for Ferrari. Ferrari is a very different automaker because they are more of a niche market, a high price market. They generate a 50% gross margin, but they made 13,748 vehicles over the past year, and they're selling them at a much higher price point than Rivian is. So this is really going to be the conundrum for Rivian going forward is, yes, they are at a very high price point between $70,000 and $100,000 typically for most vehicles right now. But are you going to be able to maintain that when you go from producing 57,000 vehicles in a year to producing 200, 400,000 vehicles in a year? I don't think that's going to be the case. Even that $70,000 price point is going to be comparable to much bigger SUVs in the traditional ICE market. It doesn't seem like those SUVs are going anywhere. Now Rivian is trying to move into the smaller vehicle market with the R2 and the R3. Typically, those don't have the same margins as bigger SUVs. So all of this is kind of in conflict. All of these automakers are saying, hey, you know what? Electric vehicle demand is not as strong as we thought it was. We are going to actually pull back on our electric vehicle investment and our rollout with some of our EVs. That's what a lot of the traditional automakers are saying right now. Tesla is saying the exact same thing with its numbers. Rivian charging forward, saying that there's going to be extremely high margins, extremely high free cash flow margins. And I just don't think there's a lot of evidence. And part of the problem with this is the company's balance sheet. So I want to get to that next. This is the current balance sheet. $5.76 billion worth of cash, $2.1 billion in short-term investments. So add those two together, you get about $7.9 billion in cash. Now, $1 billion of that came from Volkswagen, an initial investment. There is another $4 billion expected to come from Volkswagen as part of their partnership, their joint venture. That will be finalized later this year is what they're expecting. So add that in, you get to about $11.9 billion in cash on the balance sheet. So here's the problem. You have the operating expenses on the run rate, about a $4 billion run rate for operating expenses. Some of that is going to be non-cash costs, so stock-based compensation. Let's use $3.5 billion as their operating costs, the cash expenses that are going to go into that. On top of that, you have about $1.5 billion expected to be spent in capital expenditures. So $5 billion is going to be going out the door between OPEX and CAPEX. Those are ballpark numbers, but that's about right. We're midway through 2024. The R2 in Georgia is not expected to launch until what they say is the first half of 2026. Expect that to be the very, very end of the first half. So between now and then, the company's going to burn through about $10 billion worth of cash. That leaves you with cash on the balance sheet of $1.9 billion if just those ballpark numbers are correct. Now here's the problem. We haven't yet gotten to profitability. That, of course, is projected, but I question that. And you still have this number right here, $5.5 billion worth of debt that Rivian has on the balance sheet. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So really the biggest question for Rivian is, what are their gross margins going to be? What are their operating margins going to be when they actually get to scale and they're producing more like 400,000 vehicles? And I think the one data point that did come out this quarter was the company's commentary and actions that we saw in relating to discounting R1 vehicles when the second generation vehicle was being made. They talked about this on the conference call, but management said, it makes sense when we're updating to a second generation vehicles that people don't want to buy the first generation vehicle, so we had to discount those. Here's the problem with that. You're having relatively small production numbers. You should have ample demand for that relatively small number of production. That's the Ferrari model. We're going to be able to charge a high price because we're going to make so few vehicles. Our demand greatly exceeds our supply. Because as you increase supply, now your supply is going to meet that demand, maybe even exceed that demand. Now you're going to have to deal with price pressure. This is what Tesla has seen over the last 18 months. They're no longer living in a world of excess demand. They're living in a world of excess supply, so they have to lower their prices to actually compete in the market. Is Rivian going to face the same challenge as they go from making 57,000 units to 200,000 or 400,000 units? I think they are. This is typically what happens in manufacturing. You increase supply, you have to increase demand at the same level. And if you're already having to discount vehicles when you have very, very low supply, that's a bad sign for your demand long term. So this is the fundamental problem with Rivian right now. A lot of promises about the future, and good thing for them is they don't have to actually deliver on those for a couple of years. But keep this in mind as we get more results coming out, because I think the market hopes there's going to be a ton of demand for something like the R2 and the R3 when those launch. But there better be not only high demand, but high prices as well. And that's in a very, very competitive electric vehicle market that everyone else is seeing weakness except for Rivian somehow. But let me know what you think about the quarterly results. Leave those in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.